Are you ready to start building wealth but feel completely lost when it comes to how to invest in stocks? You are definitely not alone in feeling that way. The world of investing can seem incredibly complex and overwhelming at first glance. Many beginners hesitate because they think you need a finance degree or a huge amount of money to get started. That simply isn't true. Investing is accessible to everyone, and taking the first step is often the hardest part. Our primary goal today is to demystify the stock market for you. We want to break down the process into simple, manageable steps. By the end of this guide, you should feel much more confident about how to invest in stocks. We aim to empower you to start your financial growth journey right now. This guide is specifically designed for beginners with absolutely zero prior investment experience. We'll cover the fundamentals without any confusing jargon. Our overall objective is to educate and motivate you. We want to show you that investing is achievable and can be a powerful tool for your financial future. Let's get started on this exciting path together. Let's begin by understanding the fundamental reason why investing in stocks is a smart move for your money. What exactly are stocks? When you buy a stock, you are essentially buying a small piece of ownership in a company. Think of it like becoming a tiny partner in a business. As that company grows and becomes more profitable, the value of your ownership stake, your stock, tends to increase. This is how you make money from stock investments over time. Historically, stocks have delivered some of the highest long-term returns compared to other investment options. This includes savings accounts, bonds, or even real estate. While past performance is never a guarantee of future results, the long-term trend is clear. Investing in stocks allows your money to work hard for you. Instead of just sitting in a low-interest savings account, your money has the potential to grow significantly over the years. This growth is often referred to as compounding, where your earnings start earning their own returns. Compounding is a powerful force in wealth building. The earlier you start, the more time your money has to grow exponentially. Learning how to invest in stocks is a crucial first step if you want to harness this power and build long-term financial security. It's about putting your money to work so it can potentially outpace inflation and help you reach your financial goals faster. Investing isn't just for the wealthy. It's a tool for anyone looking to build a better financial future. Before you can start buying stocks, there are two essential things you need to have in place. These are foundational steps that prepare you for your investing journey. The first is opening a brokerage account. A brokerage account is simply an account you open with a financial institution that is licensed to buy and sell stocks and other securities on your behalf. Think of it as your personal gateway to the stock market. You can't buy stocks directly from companies. You need a broker as an intermediary. There are many reputable brokerage firms available, both online and traditional. Some popular options known for being beginner-friendly include platforms like Fidelity, Charles Schwab, Robinhood, or eToro. Many of these platforms have user-friendly interfaces and educational resources. When choosing a broker, consider factors like account minimums, trading fees, available investment options, and educational tools. Many brokers now allow you to start investing with a very small amount, sometimes as little as $50 or even less. Don't feel pressured to start big. Consistency is more important than the initial amount. The second crucial step is defining your investing goal. Why are you investing? Are you saving for a down payment on a house in 5 years? Are you planning for retirement in 30 years? Or perhaps saving for your child's education? Having a clear goal is vital because it will influence your investment strategy. Your time horizon, how long you plan to invest, is a major factor in deciding what types of investments are appropriate for you. Longer time horizons generally allow for taking on a bit more risk for potentially higher returns. Shorter time horizons might require a more conservative approach. Your goal will also help you determine how much you need to invest regularly to reach your target amount by your deadline. Take some time to think about what you want your money to achieve for you. Setting a clear goal provides direction and helps you stay disciplined, especially during market ups and downs. It gives your investments a purpose beyond just watching numbers on a screen. Okay, you've opened your brokerage account and you have a clear investing goal. Now comes the big question. What should you actually invest in? For beginners, it's often best to start simple and focus on diversification. Diversification means spreading your investments across different assets so that if one performs poorly, it doesn't sink your entire portfolio. It's like the old saying, don't put all your eggs in one basket. Diversification helps reduce risk. Here are 3 beginner-friendly ways to invest in stocks that offer built-in diversification. First, consider index funds. An index fund is a type of mutual fund or exchange-traded fund, ETF, that is designed to track a specific market index. A famous example is an S&P 500 index fund, which holds stocks of the 500 largest U.S. companies. When you invest in an S&P 500 index fund, you are essentially investing in all 500 of those companies simultaneously. This provides instant diversification across major sectors of the U.S. economy. Index funds are known for their low costs and simplicity. They aim to match the performance of the market index they track, rather than trying to beat it. This passive approach often results in lower fees compared to actively managed funds. Investing in an index fund is a straightforward way to own a broad slice of the stock market. Second, look into exchange-traded funds or ETFs. ETFs are similar to mutual funds in that they pool money from many investors to buy a basket of assets, often stocks. However, ETFs trade on stock exchanges throughout the day, much like individual stocks. ETFs can track various indexes, sectors, or investment strategies. You can find ETFs that track the S&P 500, international stocks, specific industries like technology or healthcare, or even bonds. They offer diversification and flexibility. ETFs are generally low cost and transparent. They allow you to invest in a diversified portfolio with a single purchase. For beginners, broad market index ETFs are an excellent starting point, providing wide diversification with minimal effort. Third, you might consider investing in blue-chip stocks. These are stocks of large, well-established, and financially sound companies with a long history of stable performance. Think of globally recognized names like Apple, Microsoft, Coca-Cola, or Johnson & Johnson. Blue-chip companies are often leaders in their industries and tend to be less volatile than smaller, newer companies. While they may not offer explosive growth potential, they are generally considered safer investments and may even pay regular dividends. Investing in a few blue-chip stocks can be part of a diversified portfolio. However, relying solely on a few individual stocks, even blue chips, is less diversified than using index funds or ETFs. For maximum beginner-friendly diversification, index funds and ETFs are often recommended. Start simple with 1 or 2 of these options. You don't need to spend hours trying to pick the next revolutionary startup stock. Building a solid foundation with diversified, low-cost options is a smart approach for beginners. Once you know what you want to invest in, the next question is how and when to buy. Many new investors worry about timing the market, trying to buy low and sell high. Here's a secret. Consistently timing the market perfectly is incredibly difficult, even for seasoned professionals. Instead of trying to predict market movements, a highly effective and beginner-friendly strategy is called dollar-cost averaging. This method takes the stress out of trying to time your purchases. It's about consistency and discipline. Dollar-cost averaging means investing a fixed amount of money at regular intervals, regardless of whether the market is up or down. For example, you might decide to invest $100 every 2 weeks or $200 every month into your chosen index fund or ETF. When the market price is high, your fixed dollar amount buys fewer shares. When the market price is low, that same dollar amount buys more shares. Over time, this strategy averages out your purchase price per share. This approach has several benefits for beginners. First, it reduces the risk of investing a large sum right before a market downturn. By spreading your investments over time, you avoid putting all your money in at a potential market peak. Second, it builds discipline and consistency. By automating your investments, you stick to your plan and avoid making emotional decisions based on short-term market fluctuations. It turns investing into a regular habit, like paying a bill. Third, it simplifies the process. You don't need to constantly monitor the market or try to guess its direction. You just stick to your predetermined schedule and amount. This makes investing much less stressful. Dollar cost averaging is particularly effective for long-term investors. While you will inevitably buy some shares at higher prices and some at lower prices, the goal is to accumulate shares consistently over many years. This allows you to benefit from the market's long-term upward trend. It's a strategy that focuses on time in the market rather than timing the market. For beginners, automating dollar cost averaging is one of the smartest things you can do to build wealth steadily and without panic. As a beginner investor, it's just as important to know what not to do as it is to know what to do. Avoiding common pitfalls can save you from significant losses and frustration. Let's look at some beginner mistakes you should steer clear of. First, avoid chasing hype stocks or investing based on trends you see on social media platforms like TikTok or online forums. These often involve speculative investments in volatile companies that are being talked up, rather than based on solid fundamentals. Investing based on hype is essentially gambling, not investing. These stocks can rise quickly but often crash just as fast, leaving investors who bought in late with significant losses. Focus on understanding the investments you make, not just following the crowd. Second, avoid going all in on one company or one type of asset. This relates back to the importance of diversification. Putting all your money into a single stock, no matter how promising it seems, exposes you to immense risk. If that one company faces problems, your entire investment could be wiped out. A diversified portfolio spread across different companies, industries, and asset types is much more resilient to individual setbacks. Third, do not invest money that you will need in the short term, say within the next few months or even a year or two. The stock market can be volatile in the short term. There's a risk that the market could be down when you need to withdraw your money. Stocks are long-term investments. You should only invest money that you can afford to leave invested for several years, ideally 5 years or more. This gives your investments time to recover from any short-term dips and benefit from long-term growth. Finally, avoid panicking and selling your investments during market downturns. Market corrections and crashes are a normal part of investing. Selling when prices are low locks in your losses. Instead, view downturns as potential opportunities to buy more shares at a lower price using your dollar cost averaging strategy. Staying invested through volatility is key to long-term success. Investing successfully isn't just about picking the right stocks or strategies. Your mindset plays a crucial role. Developing the right perspective is essential for navigating the ups and downs of the market and sticking to your long-term plan. Understand that the stock market goes up and down. This volatility is completely normal. Market prices are influenced by countless factors, including economic news, company performance, investor sentiment, and global events. There will be days, weeks, or even months when your investments lose value. This can be unsettling, especially for beginners. However, it's important not to let short-term fluctuations dictate your decisions. Stick to your plan. You created an investment strategy based on your goals and risk tolerance. Trust that plan and avoid making impulsive decisions driven by fear or greed. Emotional investing is one of the biggest destroyers of wealth. Remember that wealth building through stock market investing is a marathon, not a sprint. It takes time for the power of compounding to work its magic. Focus on consistent investing over many years rather than trying to get rich quickly. Patience is a virtue in investing. Avoid checking your portfolio constantly, especially in the early days or during volatile periods. Focus on the long-term trend, which historically has been upward for the stock market. Educate yourself continuously, but don't get bogged down in trying to predict every market move. Understand the basics, stay disciplined with your contributions, and maintain a long-term perspective. Cultivating a calm, rational, and patient mindset will serve you well throughout your investing journey. It helps you stay focused on your goals and avoid making costly mistakes driven by emotion. Congratulations! You've taken a significant step by learning the fundamentals of how to invest in stocks as a beginner. We've covered why investing is important, how to set up your account and goals, what beginner-friendly options are available, smart strategies like dollar cost averaging, what mistakes to avoid, and the importance of a strong mindset. Now you know that investing in stocks is achievable, even if you're starting from scratch. The key is to take action and start putting what you've learned into practice. Don't feel like you need to be an expert before you begin. Remember these key takeaways. Start small. You don't need a large sum of money to open an account and make your first investment. Consistency is far more important than the initial amount. Stay consistent with your investments, ideally by setting up regular contributions using dollar cost averaging. This builds discipline and averages out your purchase price over time. Think long-term. Stock market investing is about building wealth over years and decades, not days or weeks. Be patient and stay invested through market fluctuations. Taking that first small step is the most important part. Open that brokerage account, set your goal, choose a simple diversified investment like an index fund or ETF, and start investing a small amount regularly. We hope this guide has helped make the investing process feel less intimidating and more accessible. You are now equipped with the fundamental knowledge to begin your financial growth journey confidently. If this guide helped you understand how to get started with investing, please consider liking this video and subscribing to our channel for more clear and actionable investing tips. This is Online Investment Compass, helping you invest smarter every time.